Go.
Reconstructing the income and expense statement. Table 12.4 is an example of an owner's operating statement for a 10-unit apartment building, the Colony Key Apartments. The rent is $1,600 per month for a potential gross income of $182,400. The actual rent of $1,600 per unit per month is supported by rentals of several comparable apartments in the area. Therefore, the market rent would be $1,600 per unit per month. The owner's statement shows an income of $182,400. The difference between the potential gross income of $192,000 and the actual rent collected is the vacancy and collection loss of $9,600. Because there is no miscellaneous income, the effective gross income of the property is $182,400. The items listed in the owner's operating statement are typical. Each is discussed separately below, and recommendations are made on how the assessor should treat the item. So, I'm not going to read that.
You're not reading it. What's important are these items that we're fixing to read, and they're going to say this is how it should be treated.
Right. Well,
differently than what the owner
these words is
those.
this.
Yes.
So, but it's these words plus the appraiser part of it.
Yeah. That's the part I got to learn.
Really? I didn't figure that was important. When reconstructing an income and expense statement supplied by an owner, each item must be evaluated on the basis of 1. Accepting it as stated, a typical and reasonable item, 2. Rejecting it, an invalid expense, or 3. Prorating the expense calculated as an annual expense and accounting for all units in the property. Real estate taxes. Real estate taxes can be taken as an expense or provided for in the capitalization rate. If the appraisal will be used to set the assessed value, real estate taxes should be removed as an expense item and included later in the effective tax rate. Mortgage payment. The mortgage payment should never be included as an expense in the income approach. The capitalization rate for improved property always includes a provision for return on the capital investment. The mortgage payment or debt service includes the payment of principal amortization and interest on the mortgage. Insurance. The 3-year premium must be prorated so that only 1 year is included. 1/3 of the premium should be taken as an expense for this year's operating statement. Miscellaneous repairs. These include such items as equipment repairs, plumbing, broken glass, and light bulbs. Management. This item does not appear on the owner's statement, but is a necessary and proper expense for this type of property. Analysis of comparable properties in the area shows that management fees are typically 5% of the effective gross income.
Oh, so therefore, if it's added in, it's helping the owner. It's going to help the owner.
Therefore, 5% is used in the reconstructed statement. New roof cover. The new roof cover should be set up in the reserves for replacement category. The annual charge is derived by estimating the cost of the item and dividing the cost by the total useful life. In this illustration, the total economic life of the roof cover is considered to be 10 years. Refrigerators. This is another item that should be set up as reserves for replacement. If 3 refrigerators cost $6,000, 1 refrigerator costs $2,000. If refrigerator costs $2,000, the cost for the apartment complex would be 10 times $2,000 or $20,000. Based on the assumption of a 10-year life, the annual charge under the reserves for replacement category would be 10% of $20,000 or $2,000. Stoves. The stoves would also be a part of the reserves for replacement category. They also have an estimated 10-year total useful life. The reserve allowance is calculated in the same way as for the refrigerators. Utilities. Utilities are a proper expense in the operation of the property. Advertising. Advertising is an allowable expense. Water. Water is simply an itemization of a utility. Paint to units. This is classified as interior painting in the reconstructed statement and is treated as reserves for replacement. If 2 units can be painted for $2,600, 10 units can be painted for $13,000. Based on the assumption that the paint will last 4 years, 25% of the $13,000 is the appropriate annual charge for interior painting. Depreciation. Depreciation is not applicable because it is taken care of in the capitalization rate. Also, the depreciation shown on the owner's statement for income tax purposes may have no relationship to the remaining economic life of the property. Because future income is the reason an income property has value, past depreciation is of little concern. The remaining economic life of the property determines the duration of the future income. Concrete patio. This capital improvement should not be included in an annual expense in the income approach. Exterior painting. This item should also be included as reserves for replacement. Exterior painting has a 3-year total useful life, thus one-third of the $12,600 or $4,200 would be the annual allowance. Lawn care. This is proper maintenance expense. Extermination. This is also a proper maintenance expense. Heating and air conditioning and water heaters. Because this owner's statement does not include any mention of heating, air conditioning, or hot water heaters, those items should be included as reserves for replacement. The annual charge for the heating system is based on a total cost of $42,000 for the system and a total useful life of 15 years. The annual expense for water heaters is based on an individual cost of $1,200 per heater or $12,000 for the 10 units. Table 12.5 is the assessor's reconstructed income and expense statement showing the results of analysis and conclusions by the assessor regarding the expenses. The reconstructed expense statement shows a total expense of $55,840. This amount represents the proper expense figure to be deducted from the effective gross income to arrive at a net operating income for the property. In this case, the potential gross income is $192,000 and the actual rent collected is $182,400. This indicates a vacancy and collection loss of $9,600 or about 5% of potential gross income based on the assumption that this is a typical vacancy and collection loss. The following calculations are used to arrive at net operating income. Potential gross income, $192,000, less vacancy and collection loss of 5%, $9,600, equals effective gross income of $182,400, less expenses of $55,840, equals net operating income of $126,560.
Okay.
Operating expense ratios. Ratios of expenses to income must be developed. When used properly, these ratios can provide a quick check on the expense figures for comparable properties and can be developed for extensive use in mass appraisal work. A common misunderstanding about expense ratios is whether to use potential gross income or to calculate a ratio of expense to effective gross income. The assessor must be aware of the danger of comparing an expense ratio developed using potential gross income with an expense ratio using effective gross income, which provides for vacancy and collection loss.
No.
Either potential gross income or effective gross income can be used to develop expense ratios. However, their development and use in an appraisal must be consistent for each comparable property. In the Colony Key Apartments example, the ratios are based on effective gross income. The percentage of effective gross income used to pay expenses is calculated by dividing the total expenses by the effective gross income. When the total expense of $55,840 is divided by the effective gross income of $182,400, the resulting expense ratio is 30.6%. In other words, the expense necessary to keep the property operating is 30.6% of the effective gross income. Each item of expense can be compared in the same manner. The ratios shown in the reconstructed income and expense statement are calculated individually by dividing each expense amount by the effective gross income. By calculating the individual expenses calculated as a percentage of effective gross income, the assessor can quickly identify expenses that appear to be out of line with the expenses of comparable properties. The dollar amount may differ from one apartment building to another, but the percentages represented by the expense should be reasonably comparable from one property to the other or of the same type. Operating expense ratios vary widely from property to property and area to area. Among the factors that affect operating ratios are number 1, terms of the lease, number 2, type of property, number 3, age and condition of the property, number 4, type of tenants, number 5, management, and number 6, geographical area.
Okay.
Summary. The steps for determining net operating income before discount, recapture, and taxes are deducted as follows. Number 1, estimate potential gross income. Number 2, deduct for vacancy and collection loss. Number 3, add miscellaneous income to determine the effective gross income. Number 4, determine operating expenses. And number 5, deduct operating expenses from the effective gross income to determine net operating income before discount, recapture, and taxes are deducted. Potential gross income is an annual market rent for the property at 100% occupancy. From such sources as buyers and sellers, commercial property managers, realtors, and public records, rental market data must be collected. Leases ordinarily detail in the terms and other factors reflecting considerations between tenant and owner. Types of leases: month-to-month, short-term, long-term, percentage, graduated, and renewal. Lease considerations: date, names of owner and tenant, reference, legal description, term, amount of rent, owners and tenants' responsibilities, right to sublease, option to renew, tenant improvements, security, termination, and special provisions. Types of rent: contract, excess, deficit, percentage, minimum, overage, and market. Rental units of comparison: square foot, rooms, apartments, space, percentage of gross business income, GLA and NLA. Effective gross income is a potential gross income less vacancy and collection loss plus appropriate miscellaneous income. Vacancy loss: a necessary deduction because property will not remain fully rented for an entire period of life, determined by study of comparable properties and analysis of their rental histories. Collection loss: the loss resulting from the failure of tenants to pay the rent. Miscellaneous income: income from sources other than the actual rent, parking, laundry facilities, vending machines, and so on. Net operating income is the income remaining after operating expenses have been subtracted from effective potential gross income. Net operating income could also be called gross cash flow because it is the income before the depreciation expense. A non-cash expense is deducted. Determining operating expenses requires a thorough analysis of typical expenses by property use type to determine proper and improper expenses. Replacement of short-lived items should be annualized and included as reserves for replacement. Proper expenses as reflected by the market are management, salaries, utilities, supplies and materials, repairs and maintenance, property taxes, insurance, miscellaneous, and reserves for replacement, items necessary to maintain the rental income of the property. Improper expenses are depreciation, debt service, income taxes, capital improvements, when operating statements are reconstructed to calculate net income, and owner's business expenses. Operating expense ratios provide a quick check on the expense figures for comparable properties.